With mortgage rates going down, there's a lot of opportunity going on right now to consolidate debt. We think there's going to be even better opportunities in the future, but it's definitely a time to start paying attention to mortgage rates. If you're looking to do debt consolidation or a cash out refinance to consolidate your credit card debt, why would you consolidate credit card debt with a cash out refinance? Lower interest rate. You're going to have a much, much lower interest rate on your mortgage than you will a credit card. So if you can consolidate all these 20+% interest rates into something even at 7 or below, you're saving a lot of money on that portion of your debt. Second, a single monthly payment. Have you ever had a credit card where you're like, oh shoot, I forgot to pay it, and you get a late, but it's just because you completely forgot and you thought it was on auto pay or something happened and it just slipped your mind? I mean, that's happened to me more than once. So a single monthly payment is a great way to consolidate all your debt. You make one single payment, nothing else to worry about, nothing else to think about. So very streamlined, easy process to manage your debt once you consolidate it into a cash out refinance. Fixed payment schedule, just like I mentioned previously, your mortgage is due on the 1st and it's late on the 15th. You know that. You're not going to forget that. That's every single bill now that you owe. And so that can be very convenient for your life. Now, there are potential tax deductions available and possible with a cash out refinance. I am not a CPA. I'm not going to make a video telling you that there are tax deductions available. However, they are possible. I do know that. So you might want to talk to a tax preparer. But there is potential for tax deductions when doing a cash out refinance, depending on what you're doing with the proceeds. A longer repayment period. This is, the term of your mortgage. If you do a 30-year fixed, 15-year fixed, 10-year fixed, you're going to have that repayment period. So if you do consolidate all your debt, and go into a 30-year fix, you are in a longer payment period. That can be a very good thing. You can also look at it as a bad thing because you're stretching the debt over a longer period of time. However, if it's at a lower interest rate and it's fixed over a set period of time, that's a very detailed, organized way to pay off your debt, right? Improved credit scores. Now, once you consolidate all your debt and have a lot less liabilities out there, especially high balances, like balances that go up to the limit on your credit card, that can really affect your credit score in a negative way. So once you clear all that out, you should see a very much improved credit score. The debt reduction strategy. Now, if you are struggling to pay all these credit cards everywhere, just think if you can consolidate all the debt and manage it in a debt reduction strategy where you can even make payments over the monthly mortgage payment in order to really hammer down that balance. It's a very great strategy to move forward in life and really handle the debt that you've acquired. And don't worry, most people have had a situation where they've been in more debt than they wanted, at least once in their life. It's a very common thing. It's not your fault. Things happen. Life happens. We all have had situations we don't want to be in that we've got to deal with. And this is a great way to deal with a situation if it's an opportunity for you. If you want to find out, I'm Garrick Wordmuller, President, CEO of Fresh Home Loan, Inc., and I look forward to helping you. The risks that you can have of consolidating your debt and consolidating credit card debt into a cash out refinance. Now, you will have a longer mortgage term. I mentioned previously that, a good reason to do it is for a fixed longer term payment, but it could also be looked at as a negative, as I've mentioned as well, where you are going to be in a longer payback period possibly than what your credit card currently was, depending on that situation, of course. Increased mortgage balance. Your mortgage will go up. You will lose equity in your home when you do a cash out refinance. However, if it's working towards a greater good and you're in a long-term living situation, I really don't see any problem with eliminating some of that higher interest rate debt depending on your first mortgage situation, deeming it's the right situation for you. Closing costs. There's some really good options when rates are going down for closing costs. I'd call myself about that specifically. No joke, as opposed to what some of these other retail banks try to do that I've seen on their loan estimates. But do watch out for closing costs. You shouldn't be paying a lot for a refinance, regardless of whatever you're doing on a conventional or government refinance. Risk of default. Now, if you are having trouble making your payments, you don't want to consolidate all your debt into your mortgage and then you can't make your mortgage payment. That would be tragic and horrendous, and it's definitely something you don't want to do. If you're going to consolidate all your debt and you're not going to be able to make that mortgage payment, don't do it. We'll figure out another way to handle your liabilities that are revolving, meaning not tied to real estate. And then you got to deal with them separately. That's what I'm trying to say. So anyway, before consolidating debt, you should always speak with, I would say, a financial person and also an independent mortgage broker that's seasoned and looking out for your best interests, such as myself, Garrick Wordmuller, Fresh Home Loan Inc., President, CEO, independent mortgage brokers that work for the people.